Charts are for followers, the tape is for masters. Before the screen gave you colors, Jesse Livermore saw momentum in the silence of numbers. I want you to forget your RSI, your MACD, your fancy trend lines for a moment. Livermore had none of that, yet he read the market's mind with chilling accuracy. His method was based on a simple, terrifying truth: the market moves in a direction that offers the line of least resistance. That line, that invisible trend line, was not drawn on paper, it was sensed through ruthless observation. He realized that the market's true momentum is not a technical pattern, it is a psychological current created by millions of human beings giving into fear and greed. To find this invisible line, you must first master observation, the first phase of his system, the solitude of the speculator. This means eliminating all noise, all opinion, all distraction, and focusing solely on the price and the volume. This intense focus led him to his only indicator, the speed and flow of the numbers. The paper ticker tape was not just data, it was the heartbeat of the crowd, and Livermore learned its unique rhythm. Phase 2 is the discipline of the tape. Livermore did not look at a finished chart, he watched prices being printed in real time, minute by minute. He was looking for anomalies, for subtle shifts in the flow of transactions. He asked simple but profound questions. Is this stock advancing easily, or is it struggling? Is the volume confirming the move, or is it drying up? He knew that if a stock rose easily on increasing volume, the invisible trend line was up. If it struggled to move higher and required massive effort to gain a point, the resistance was high and the momentum was false. The modern equivalent of the tape is watching level to data, order flow, and the speed of transaction printing. It is the ability to filter out the meaningless chop and see the heavy institutional commitment. This required immense patience and a mental firewall against impulse. If you had to rely on only one piece of data, price or volume, which would you choose and why? Comment your answer below. His discipline of watching the flow led him to his core philosophy: the true direction of the momentum. Momentum is not a line on a screen. Momentum is the market's path of least resistance, and you must never fight the path. Phase 3 is defining the invisible trend line. For Livermore, the invisible trend line was simply the direction in which the stock was moving with the least difficulty. If a stock consistently recovered quickly from dips and broke new highs with minimal resistance, the momentum was clearly upward. Conversely, if rallies failed quickly and subsequent drops accelerated, the momentum was down. He knew that the market, like a river, flows along the easiest course. Trying to buy a weak stock simply because it looked cheap was trying to fight the river, and that always led to being swept away. The true trend line is not geometric, it is psychological. It reveals the path of least opposition from the big players. His success came from aligning his vast capital with this path, waiting until the psychological current was so strong that failure was highly unlikely. This momentum current could only be captured effectively when a key event occurred, a moment he called the pivot point. You do not enter a market when you feel like it, you enter only when the market gives you an unmistakable command. Phase 4 is the pivot point rule. Livermore knew that trends rarely reverse instantly, they pivot. The pivot point was the crucial price level where a stock demonstrated that it was ready to decisively break out of a trading range or continue a major trend. After a consolidation, this point was his command to act. He would wait for the stock to surpass a previous significant high on a continuing uptrend, or break a significant low on a continuing downtrend. He did not buy early, he bought confirmation. He was willing to pay a slightly higher price to receive the market's validation that the invisible trend line was accelerating. The pivot point was his ultimate defense against the ego trap. It forced him to trade reality, not hope. If a stock failed at the pivot point, the system screamed, stay out. Do you enter trades when the price breaks a high, or do you wait for it to pull back after the break? Comment your strategy. But waiting for the pivot is agonizing, and many traders fail in the impatience leading up to it. Impatience is the amateur's virtue. It forces them to trade the noise, while the professional waits for the signal. Phase 5 is the impatience trap. the waiting period before the pivot point is the most psychologically draining part of trading. The market knows you are waiting and it sends small enticing movements designed to lure you in early. This is the ultimate test of Livermore's discipline. If you enter before the pivot, you are betting on a guess, not on confirmation. This premature entry drastically increases your risk and destroys your conviction when the inevitable volatility hits. Livermore realized that the market exists to test your patience and reward your adherence to the system. He famously said, "It was never my thinking that made the big money for me, it was always my sitting." His sitting was the refusal to trade before the pivot. His failure was always when he violated this rule, when he let boredom or FOMO push him in before the market gave the green light. The key to overcoming this trap is the calculated execution of the entry itself, a phase based on trust. Never commit your entire capital to an idea, committed only to a confirmed reality. Phase 6 is test and scale. Even when the pivot point has hit, Livermore did not plunge in with his full position. This phase is designed to manage the psychological fallout of being wrong. He would initiate a small test trade, usually a fraction of his intended size. This small commitment was his inexpensive way of asking the market a final question: is the breakout real? If the market immediately went against his test trade, he would liquidate it instantly for a small loss, a cheap tuition fee. If, however, the market moved in his favor, confirming the pivot, he would then begin to scale aggressively into the full position. He was averaging up on a winner, never down on a loser. This scaling method ensures that your largest capital commitment is always placed into a position that the market has already proven correct, thereby protecting your conviction. This system of observation and testing was famously demonstrated during his crucial operations in the commodity markets. The mistake isn't losing money. The mistake is letting a loss exceed the absolute predetermined price of tuition. Phase 7 is the unbreakable mandate: cut losses short and let profits run. 1. The loss rule: the first loss is the cheapest. This is the non-negotiable rule. Take the small immediate loss defined in phase 3 the moment the market proves you wrong. This preserves capital and psychological integrity. 2. The profit rule: patience in possession. Do not take profits early out of fear. Use a trailing stop loss to protect gains and then sit still. Allow the big asymmetric gains to materialize. You only liquidate when the trend shows clear defined weakness. This dual mandate creates the essential asymmetry: small controlled losses versus and capped large gains. How do these century-old rules survive in today's high-speed algorithmic world? The technology has changed. The human heart has not. Livermore's rules are the only defense against algorithmic speed and digital noise. Phase 8 is the digital firewall. Modern markets amplify the psychological challenge with noise and speed. Social media, HFT, Livermore's solitude and observation are now the noise filter. You must block out the digital din and trust only the price action and volume. Your modern tape. The speed of trading makes the hard stop loss. Phase 7 a survival tool. Do not hesitate on execution, as leverage will punish emotional delays instantly by focusing on longer time frames and waiting for multi-week trend confirmations. Phase 4 you sidestep the noise where algorithms dominate, ensuring your psychological edge remains intact. Understanding the rules is one thing. Implementation requires a mechanical protocol. The master trader is not a prognosticator. He is a technician. He simply executes a proven plan. Phase 9 is the execution protocol. This process removes emotional decision-making. 1. Observe. Phase 1 identify the thesis. 2. Define risk. Phase 3 set the hard stop and max loss. 3. Confirm. Phase 4 set the trigger price. 4. Test. Phase 5 enter with 25% position size. 5. Scale. Phase 7. If confirmed, scale into the remaining position, averaging up on a winner. 6. Sit still. Phase 7 manage the profit with the trailing stop. Ignore noise. 7. Exit. Phase 7 Liquidate when the trend structurally breaks, not out of fear. 8. Review Phase 6 Conduct. Post-mortem, focusing only on process adherence, not P&L outcome. This mechanical adherence ensures you commit to small defined risks while allowing winners the freedom to achieve asymmetric returns. We now tie it all together with the ultimate realization. You leave this documentary armed not with a secret stock tip but with a secret self-mastery. The system is complete. The victory depends only on the man who wields it. We have completed the 10 phases. Livermore taught us that trading is 10% analysis and 90% self-control. The 10 phases are your armor against ego and impulse. The freedom in trading is the freedom from emotional reactivity. When you execute this system consistently, you are no longer trading the market. You are trading your system, and your system has a proven profitable edge. Do not seek the quick score. Seek the systematic advantage. The market will try to trick you every single day. But now you know the truth. The only person who can truly break your system is you. Honor the phases. Trust the process. And may your discipline always be your greatest asset. Trade systematically and good luck.